second half of finance. Are you excited? Yay. This part's easier, I think, than the last part. All right, so it says installment note on your piece of paper or on your booklet. And you're going to write down, look at it, starting off with a nice long one, first thing. Principal and interest, specific amounts, and intervals. So when you have a mortgage payment, you're paying principal and interest, and you're paying a specific payment. A lot of times you have impound, so you're paying taxes and insurance. But realize that when you first get your mortgage, you're paying mostly interest. So like if your payment's $2,800 a month, you're probably paying $2,300 in interest. So while you're still writing, I can't say it, writing, I'll wait. Next one's easy and short. How about that? Nice. So I'll get it up there. Fully amortized. So when you have a loan that's fully amortized, that means that you're paying principal and interest, and by the time you're all done, the last payment pays it completely off. So fully amortized is liquidated. So most people get 30-year loans, so they're long-term, right? But the interesting part is most people only live in their homes for 7 to 10 years. So you guys, once you have a client, keep track of them because they're probably going to move eventually. I don't know they say that, but I've been in my house for like 35 years. I'm a rebel, I tell you. So with a long-term loan, payments to principal increases while interest decreases. So like I just said, when you're paying your payment at the beginning of the loan, you're paying mostly interest and very little principal. But as you're paying it, about halfway through, you start paying more principal than interest. And at the end of the loan, you're paying almost all principal. So that one kind of catches people off sometimes. You guys went from being all talking to me to all quiet. Shh. But I know, that's what we're supposed to be. We're serious. So, believe it or not, there are adjustable rate mortgages. It's going to come up in a second. This one right here, adjustable rate mortgages. Interest rate can increase or decrease. So why the interest rates are down, probably not very many people are going to get an adjustable rate mortgage. However, when rates go up, more people will get the adjustable rate mortgage. Believe it or not, people that are buying really expensive homes and getting big loans are getting adjustable rate mortgages that are fixed at a low rate for like 3, 5, 7, or 10 years because maybe they're only going to be in the house for 3 to 5 years. So they get a 7-year loan that's fixed with interest-only payments, so the payment's really low. No principal payments during the term. So this has been on the test since I took my test. It's an interest-only loan, and they call it a straight note. So that loan that I just talked about where it's fixed for 3, 5, 7, or 10 years, it's usually interest only at a low payment, and then it rolls into an adjustable. So this would be a straight note where it's interest only. There's all kinds of loans out there for your clients, you guys. If they're breathing, you should be able to get them something. There actually is something that not a lot of people know about. So if you guys get a client that you really think is destitute, there's a thing called Naca, N-A-C-A. And Naca will do no down payment with an interest rate that, I had one student in here, she's like, guess what my interest rate was? And she didn't tell me it was Naca, and the way that she said it, I go, 1, 1 1/4, she goes 1 1/8, 30-year fixed rate loan.
Wow.
No down payment, and she had a credit score of 580.
What was the amount of the loan?
I have no idea.
I heard of that, but I
Naca?
Yeah, but I was like,
It's a non-profit, but apparently it's really hard to do, but you guys can look into it. If you want to learn about it, just text me and I'll text you the girl that's a...
I went.
Huh?
I went a long time ago. I was like, this is really true.
It's really true. It's really true. Balloon payments. So if you get an interest-only loan, at some point during the time, you're going to have to pay the principal. So you're going to have one big payment called a balloon payment. So it's a partially amortized loan with a larger payment sometime at the end of the loan. A lot of people who have modifications or who got forbearances during COVID, they have a balloon payment. And you guys need to be really careful when you're doing their listing because on their mortgage statement, it will say principal balance, but then it will say deferred interest. So if they tell you they owe this, they're going to owe that plus that. So be aware of that. We're going into a whole new stage. Entire balance due. So usually when you have the balloon payment, the entire balance is due. Some people get home equity lines with entire balances due. Also be aware that some people don't think their equity line of credit is leaned against their house. So you're going to sell their house and they're going to tell you they only have a first, and then you think they have so much money coming out. And then you find out on the preliminary title report that they have a second, which is an equity line of credit. Vendor executes contracts. So the reason you guys have to learn about land contracts, not a lot of people do land contracts, but there's a program called CalVet. And on a CalVet loan, what happens is the VA, Department of Veterans Affairs, purchases the house for the veteran, and then they sell it back to him, and he's buying it from the VA. So they do it on a land contract. Vendor executes the contract, equitable title to the vendee. So the vendor is the owner, and the vendee is the person buying the property on payments. Good morning. If you need to catch up on the break, I'll give you my book. Equitable title, use and possess, obtain legal title. So the vendee is going to make payments, and once they get to a point in the contract where the title gets transferred, then they'll obtain the legal title. But in the beginning, the vendor has legal title. Vendor and vendee, beneficiary and trustor. So they're going to ask you, what is the vendor-vendee relationship like? And the vendor is like the bank, and the vendee is like the person buying the home. Default on land contract. So let's say that the veteran doesn't pay the Veterans Affairs, or maybe somebody bought, this is also a form of seller carryback. And let's say that the person buying the property stops making the payments. Quiet title suit or a quit claim deed. So depending on the relationship between the two parties, because sometimes it's always the seller whose fault it is that the new buyer can't make the payments. That's how it usually goes down. Or the renter not making the payments because it's the landlord's fault, right? So if you can get them to talk to you and you can reason with them, they can do a quit claim deed, which is just signing a document and recording it. Otherwise, you have to sue them in court with a quiet title suit. You guys are writing fast this morning. This is good. You're wide awake. Must have lots of coffee. I'm only on half a cup. Insured loans. So if you don't put down at least 20%, you're going to have mortgage insurance, which is FHA or PMI. On FHA, regardless of the down payment, you're going to have mortgage insurance. So let's say that you have a buyer. A lot of people get a buyer and they think, okay, they're a good buyer, they're going to put 20% down, so they're going to go conventional because they don't want mortgage insurance. Well, sometimes it's better to put them through FHA because they can qualify for more, because FHA is more lenient on the income and the debt. So like I have somebody right now that they only qualified for like 510 on conventional, and they're putting 25% down. And we looked at it FHA, and we were like, well, you're going to have mortgage insurance, but you qualify for 620 instead of 510. That's pretty substantial, especially in Orange County. It's still hard to find something in the sixes in Orange County. Maybe a small townhome, an itty bitty one. FHA was created to provide insurance for approved lenders. So a lot of people think that FHA is for people with low income. It's not. There's no income qualifications regarding like a cap on your income. You just have to qualify for the payment. Payments on FHA are monthly. So this part's easy, right? Compared to yesterday's finance part. Not permitted on FHA, a junior loan. All right, so you guys, I don't know why, but for the purpose of your real estate test, it says it on an FHA loan, you cannot have a second trust deed. In the real world, that is absolutely not true. You can do an FHA loan and you can get a down payment assistance program, not only a second, but also a third. You can get a down payment assistance for part of the down payment, and you can get it for the closing costs, and literally come in with almost nothing. So I don't know why the Department of Real Estate says you can't have a second trust deed. So like I said, the test is a test world, and real life is a real life world. Okay? Permitted. Gift for the down payment. So on FHA, you can have a family member or a close family friend give you a down payment. But it does have to be a gift that's non-repayable, and it has to be in writing. We like gifts, right? Christmas is coming. I like giving gifts better than getting gifts.
Yeah. Sure.
It's funner to go shopping. Pardon?
Question on the gift down payment.
Yes?
For the amount that's greater than $10,000, because it's a gift, do you still
Okay, that's way overthinking it. They can give you whatever they want. I've seen people give gifts like $25,000.
Yeah.
The tax thing is when you're going to have to talk to your CPA, and the other, I'll get you in a second. You guys are not allowed to give CPA information. So when somebody asks you stuff like that, you have to say you need to talk to your CPA, unless you guys are a licensed CPA. Same with tax questions. Like when people ask me about taxes, I know a lot about real estate. It's kind of overwhelming sometimes. And people talk to me, they're like, well, you know, I'd rather rent because I have a smaller payment. I go, great, you're going to pay a smaller payment for 35 years, and then you're going to keep paying that smaller payment. Whereas if you own the place, you would not only be able to pay it off eventually, but you'd have a big tax write-off. And then I give them the example about how I gave my son one of my properties, and instead of paying $2,500 in taxes, he got $3,200 back, just because I gave him one of my rental properties to write off. Yeah?
For 62, you said you couldn't have a second trustee, right? So no, like, second mortgage or HELOC?
Right. Correct. For the purpose of the test, not in the real world. Where to apply for an FHA loan? Most brokers are going to do FHA, I would say, because we can broker it out to a lender that does FHA, but you're going to apply with a mortgagee. Even banks do FHA and VA. Goody, we get to do VA now. You guys, VAs are the best things since sliced cheese. Get a veteran and show them how to buy 3 or 4 houses. Seriously. VA loans. Should be no veteran without a home. No down payment. And right now, you know what they did? Like, it was probably only a couple months ago. They removed the loan limit on VA. Yeah. So one of my students said that he did a $3 million VA loan. No down payment. That just gives me the chills, right? So on VA, they do have a funding fee, and that goes on top of the loan. But if they're 10% disabled, they don't have the funding fee. And in some states, they remove the property taxes if they're disabled. In California, they prorate it a little bit. So there's a lot of benefits that a lot of people don't know about, and a lot of listing agents kind of freak out when you have a veteran because they're like, oh my God, there's some fees that my seller has to pay. We'll work with a good lender because a good lender will eat up the fees that anything that the seller might have to pay. So set up as so a CalVet loan is set up like a land contract, like I said earlier. Do you sense that I'm slightly addicted to real estate? Department of Veterans Affairs is the vendor. Now, this is the one and only loan that they require. It's absolutely required. You guys all got vendor and land contract. Protected by life disability insurance. So the veteran has to get a life disability insurance policy. So if something happens to him, the VA's affair is paid off. Now, some hard money loans will make them buy life disability insurance, but those are predatory lending. CalHAFA, this is the one I was talking about that will give you money towards your down payment, your closing costs. Now, CalHAFA changes their programs a lot. I did a CalHAPA loan where they actually paid the entire down payment and leaned it as a second, and they paid her entire closing costs. The woman bought a $680,000 condo with a total of $2,500 out of her pocket, and that was reoccurring costs. Now then, a couple years later, what they did was they said, okay, too many people are using this, so we don't have enough money, so we're going to limit it to $11,000. So you have to check the program all the time. And literally, they have a class in January and a class in March. I took the class in January, and we were still paying the whole thing. And then somebody I work with went and took the class in March, and that's when they dropped it. I'm like, that is so bad. But it was because so many people were using it, and they didn't have enough money. So CalHAPA loans, first-time low-income buyers. So that was a couple of years ago, and at that time, a low-income buyer in Orange County made over $100,000. So they still were able to qualify for a loan. Yes?
What is the FHA loan limit in California?
The loan limits change all the time. It depends on the county, and all you have to do is go to the website and pull it up, and they'll tell you. You just look at the county and you look at the loan limit. And the loan limit's different for how many properties, if it's 1 to 4. If it's 1, then it's going to be a lower loan limit. If it's 4, they'll go up much higher. And if you're going to work with somebody that's going to buy units, FHA is going to be easier than conventional. But you do have to live in the property on both of them. Tax-exempt government bonds. So the money for CalHAPA comes from tax-exempt government bonds. There are loans out there, though, you guys, for investors, that all it does is as long as the property makes enough money to pay the house payment, you can get the property. How about that one? That's a new program. It's pretty good.
With the tax exemption?
Pardon?
With the tax exemption?
Tax-exempt government bonds, that has nothing to do with that.
Oh, okay.
The tax-exempt government bonds, as people buy those bonds, that's how they raise the money for the first-time home buyers to take advantage of the program. And we're on the next page. Mine are sticking together. Specialty areas. Cost of goods and services increasing over time. Kind of like right now, huh? I don't know. My favorite pizza went up like $2. No more pizza for me. Inflation. It was diet pizza, I swear. It was. Secondary mortgage market. So there's 2 times that you'll hear the word secondary. Secondary could be a second loan, so it would be a secondary loan, so it would be in second position instead of your first, so you can get a first and a second at the same time. But the secondary mortgage market is on the back side. That's where they sell and buy loans with mortgage-backed securities. So it's not FHA. Hi, you guys are gonna be loan officers after all this, right? Doesn't hurt to have both licenses. That license is easy. Well, the test is hard, but the class is easy. How about that? Mortgage bankers, mortgage companies service loans and sell them on the secondary market. So mortgage bankers use their own money by the form of a warehouse line, and a lot of times they'll keep them and service them. If they decide to sell them, they'll sell them on the secondary market, usually making about 1%. Doesn't it feel like Christmas?
Yes.
I'm totally getting excited. I don't know why I don't really do that much. Just decorate the house and then take it down. Mortgage brokers, not own money. So we use other companies. We use wholesale lenders. I think I talked about it a little bit yesterday. You guys really give your clients choices, maybe a bank and a mortgage broker. If they bank at a particular bank, have them apply there, but always have them apply to a mortgage broker, because they say there's 2 things. CAR says there's 2 things that buyers get really upset about. Number 1, lack of communication from you guys. Number 2, being turned down in the loan process. The loan process should actually be fun. I mean, I try to make it